central banks who issue the currencies, fiat currencies, are themselves technically bust. I mean, the fact is the whole system is bust, which is why I've been saying get out of credit. Really, today, it's higher bond yields. Out along the yield curve, they're still rising. And I think there are two reasons that we can put this down to. One is there is increasing risk, if you like, involved with holding dollars. I mean, this much is clear because if you're going to break the supply chains, you're going to do all that sort of stuff with tariffs and so on and so forth, then global trade is going to diminish. I mean, that is a fact. And if global trade diminishes, do you, as a foreigner, do you really need to hold so many dollars? So the idea that dollars are going to be recycled, I mean, that's against, I think, a tendency for foreigners to sell dollars, probably for their own currencies as much as anything. And the second point I would also make is that foreigners see increased risk in the dollar. So if you're going to persuade a foreigner to hold dollars, to hold US treasuries, then the yield has got to be higher. And not only that, but I know there's a sort of bit of confusion about whether the US economy is growing or whether it's going into recession or whatever. I would argue that it is actually already in recession. If you take out the 7% budget deficit out of GDP, nominal GDP, you're looking in effect at a contraction of the private sector GDP of, I don't know what, 5%, 5%. It's been doing that for the last 2 or 3 years. Now, this is terribly important because if the private sector GDP is not growing as rapidly as government debt, then government debt cannot be financed. It is a debt trap. I mean, of course, if you get someone to buy it, that's fine. But if you're a foreigner and you're looking at this from the outside, you think, hold on a minute, is this debt really worth having? And then the question that you ask yourself is, at what level of interest rate or bond yield would I be prepared to accept in return for my continuing investment in dollars? And that is the nub, because if foreigners take the view that, yeah, this is a debt trap, then actually there's no interest rate, no bond yield, which is going to attract them. We had this problem in the UK back in the 1970s. I think it was about 75, 76. We had a sterling crisis. We had a far left-wing government. I mean, an extremist government, if you like. America very kindly came in and supported sterling. It went and bought it, turned it round, but then put in the bank manager being the IMF. And the IMF forced the government of the day to take the action which they should have taken. So you had left-wing cabinet ministers resigning because they couldn't, they couldn't support the cuts in welfare or cuts in public spending or whatever, which were forced on them by the IMF. Now, the point I would make is that at that time we had 3 gilts being UK government bonds, which had coupons of 15%, 15.25%, and 15.5%. Now, coming back to today and the situation in America, and indeed in other Western economies, I can't see anything to stop it at 15%. And here we are looking at the US Treasury 20-year maturity, 30-year maturity, nudging on 5%, almost at 18-year, 20-year highs. This is a situation which is ringing some very loud bells in my mind. So I think that's the first thing that I would really look at. Yeah, absolutely. So and now that's going to go higher, in my view, simply because of the debt trap dynamics. And I think it's very important for all viewers of this podcast to really understand the dynamics of a debt trap. And that's precisely where America is at the moment. It's also, I think, where the UK is, and it is also where some governments in the European Union are. It is also potentially the position in Japan, which has such enormous debt. I mean, it's just unbelievable. I mean, debt to GDP, last time I looked at it, was something like 260, 270%. I mean, we're talking government debt, not the wider debt. So, and that's another interesting one. If you look at the yield on the 30-year JGB, 40-year JGB, if you can get that one up, that is really up. And that, I think, is a real warning sign as to the problems that Japan is now going to face. I mean, the yield on the 10-year JGB, I think, is in the order of about 10.4, 10.5%. But if you go out to the sort of 30, 40-year maturities, I mean, you're then looking at, from memory, over 3%. I mean, this is very serious stuff for a nation which is so heavily in debt. Most of that debt, incidentally, being owed to its own central bank. I mean, the Bank of Japan, I think, owns something, close to 60% of the total government debt. So you can see that we've got problems there. And our gilts, I mean, if you look at the sort of 20, 30-year gilt maturity, I mean, it's the same story there. It's just, up. Yield-wise, not price. Price is down. Now, this is terribly important because, one of the most important factors as far as equity valuations is concerned is what is the yield on government bonds. If the yield on government bonds is high, that's bad for equities. So this is effectively undermining the prospects for equities. I think, I mean, going a bit further down that rabbit hole, I think we've got to think in terms of the other side of debt. Debt equals credit. Now, credit is a good thing because all our wealth is in credit, as long as the debt on the other side of it is sustainable, which those charts are telling us maybe it's not. So effectively, we're in a credit bubble. If we're in a debt bubble, we're in a credit bubble. Now, the problem with credit bubbles is that they start imploding at some stage. And I think we've actually topped out in equities, particularly in the US. But no, I mean, the only thing is to look at it conceptually. The problem is in credit. Yeah. Get out of credit is the answer. And to get out of credit, you don't go into an asset, if you like, which depends on credit for its valuation. You can only go into money, and real legal money without counterparty risk is gold. And that's why gold has been going up over the last 2 or 3 years. Well, it's actually a bit longer than that, but it's been particularly noticeable over the last 2 or 3 years. Yeah. Well, it's a recipe for far higher gold prices. But I think it would be wrong to think that, it's dollar for dollar coming out of equities and bonds and going into gold, because there will be huge losses. The point is that when you get a credit bubble imploding, other than businesses going bust, which means that the debt is no longer valid, which wipes out the credit, what happens is that the value of credit goes down. And here we've got several considerations. I mean, we've got the consideration of equity values. That's the first thing. You've got equity values as collateral for the banking system. You've got the falling values of bonds. And on top of that, of course, you've got the falling value of currency, because currency is credit. I mean, I know a lot of economists think that currency is money. It's not, it's credit, because it's on a balance sheet of a central bank. And then this brings me to a final point, which I actually wrote about in my Substack today, and that is central banks. Central banks who issue the currencies, fiat currencies, are themselves technically bust. I mean, just look at the losses on the Fed's balance sheet, on the Bank of Japan's balance sheet, on the Euro system's various balance sheets, the ECB, the Bundesbank, the Bank of France, and Banca d'Italia, and all the rest of them. And you know, the problem that they have is that having gone into QE, they've basically, what they did was they pushed down bond yields to the lowest possible level and then went in and bought bonds. That's effectively what they did. This is what QE is. So they've all got huge losses. If these central banks were private enterprises, the directors would be in jail for trading fraudulently. But, you know, this doesn't apply to governments. Governments have a special position. And of course, we all think that governments are wonderful and they're all trying to do the right thing. Yeah, this is a load of rubbish, actually. I mean, the fact is the whole system is bust, which is why I've been saying get out of credit.